Okay, if we do break below 3,600 on a monthly, I don't think we're going to go higher for years. In the meantime, everyone's extremely excited about the Fed pivot pause, right? In the looking down into kind of March, May timeframe, and I don't see that. So I'm still looking at this underperformance both in bonds and stocks this year.
Hello everyone, I'm Giorgio Tavazza and you're watching Avanguardia Investment Media. Today we are joined by Samantha LaDuc of LaDuc Trading to talk about markets. Samantha, thank you for being here.
Thank you so much for the invite, Giorgio.
Nice. So before we begin talking about markets, for those in the audience that don't know you, could you please talk a bit about your background and LaDuc Trading?
Sure, happy to. First of all, I am a macro to micro analyst, educator, and trader. I share my insights on volatility, money rotation, but mostly I predict price action. And this is across global equities, currencies, commodities, interest rates. In fact, I'm very focused on interest rates as a way to time Fed movements. And if you can time Fed movements, you can absolutely time the direction of the market. At least in my experience, I use a combination of macro as a backdrop with intermarket analysis. That's really actually my secret sauce to spy correlation and divergences in sector rotation, again, for positioning. Excuse me, that's an alert, not my doorbell. And also the technical, fine-tuned kind of technical analysis, not only because I run a live trading room, but that I find that exits and entries, obviously, for trading really, really matter, especially the exits. And I help clients who actively trade every single day, not just retail, but also institutional. So I am very focused on helping them make money and lose less of it through market timing.
Great, thank you for this introduction. And now let's start with a general overview. When you look at the financial markets and the economy today, what do you see and what is your outlook for 2023?
All right, I kind of need to go back before we go forward because 2022 was so historical, right, on so many fronts. And this is really where I am trying to navigate 2023 because 2022 I had very high convictions and I published those convictions not just for clients in November, December 2021, but also January 2022 publicly. And this was, interviews and the rest and newsletters where I basically said I had a high conviction that after a 13-year run in NASDAQ outperformance, that it would underperform. And that the S&P would fall 20%. At the time, it was 4,800. So I had a $3,800 price target. Now, once we got to 3,800, we obviously bounced and went below it, overshot, but we closed the year at 38, 35. So very, very strong analysis in my short call when everybody else was very, very bullish, right, at that time in January. And you can see all of the big houses basically printing 5,000, 6,000 as their S&P targets for 2022. And I was absolutely the outlier seeing a pullback. And there was a reason why I had that SPX to 3,800 for 2022. It was very much focused on a growth to value rotation. So I had, put my flag in the ground in summer of 2020 and said, August of 2020 specifically, bonds are done going up, which means yields are done going down. So that translated into an uprising, if you will, of value. And most importantly, this recurring theme, and if anyone follows me on Twitter, they've seen it for 2.5 years, of things over paper, things over paper. In other words, the bond and bond proxies would start to go into distribution, and things that actually earned would be had a better value cyclical kind of rotation energy, and the rest would come up from the grave and outperform. And that worked extremely well. So growth to value rotation outperforms was one of my top calls with the SPX to 3,800. And with that was oil as an inflation hedge, another kind of repeating mantra of mine. And in fact, in March of 2021, I posted a newsletter, then made that public, that I saw crude oil going to $130 by March of 2022, and it hit. That was a nice surprise, right? It took a year, but it did double. And it picked up in earnest in November 2021, when Fed removed the word transitory from its language and started this, Fed hiking regime, which ended up being the fastest in history. And that all played into my analysis on interest rates. I had been very adamant that bonds would stop going up in August of 2020 because of the rate of change. So I study in my intermarket analysis this, really, it's secret sauce as far as I'm concerned. Everything to me, I look at as it relates to direction, intensity, like in other words, volatility, and duration. And it looked from my interpretation of my intermarket analysis that this was a momentum thrust in yields that would last several years. So it was very high, it was very, I guess, high conviction, let's put it that way. High conviction that NASDAQ would underperform, rates would rise, bonds would fall, crude oil would hit 130 by March of 2022. So last year I had a really strong, let's just say, track record, okay? Now, and by the way, the firm also grew very, very strongly. So, I added contributors. We now have 10 on the trading desk, 5 of which are women. I have 3 products. I have a beginner product which is Discord community. I have my intermediate product, intermediate level traders and investors called Fishing Club. And I have an advanced product, which is Macro Advisor Edge, which is run by a longtime client and hedge fund manager, Craig Shapiro. So I basically, during COVID, expanded, right? Not just my purview, but also the firm. And we've been doing a lot of really exceptional work. So now kind of move forward into 2023. And so far, nothing has changed, except we had a very, very large momentum rotation that I called in early January, January 5th. In fact, it was this current rotation that's now gotten so many bulls excited, right? That we're going to continue on this secular bull rotation versus where I'm at right now, which is this is a solid bear market rally and nothing more than a bear market rally. But I'm in prove it mode. So if I can see some very key net buying and other intermarket tells, basically get where I need them to get to confirm or deny, right? I am still in the camp of this is a bear market rally with one more leg lower in tech. So the tech, the growth, the high beta, that stuff, which very much rolled over. I've had basically got the first call right that it would have distribution under the surface, and that collapsed in 2021, whether it be the China ADRs or the SPACs and so on and so forth, all of that with clients, to the NASDAQ underperformance where the generals would then fall in 2022. I still see one more leg down in tech growth plays in 2023. A lot of that is going to be predicated, obviously, on yields and how, if, when they can move higher. So this is a little bit tougher 2023 prediction. I do not have a price target lower like I did in 2022. I have a if then, okay? If then means if we do break below 35.30 is actually 35.88, but the point is, let's call it 3,600, okay? If we do break below 3,600 on a monthly, I don't think we're going to go higher for years. In the meantime, everyone's extremely excited about the Fed pivot pause, right? In the looking down into kind of March, May timeframe, and I don't see that. So I'm still looking at this underperformance both in bonds and stocks this year. Now we had a dramatic historic crash in bonds last year. So it wasn't just the fact that, timing it from August 2020, bonds, have stopped going up, But then we had an absolute outright crash last year in 2022. I had written an article called literally Deflation of Wages Ended with COVID. And it was in October of 2021. It was all about this impulse that wage inflation, demand for higher wages would start to it was a lagging indicator. First of all, it was inflation, is very sticky, but that was a lagging indicator that would pick up speed and outperform productivity. And that would be the enemy of bonds. And then bonds rolled over very sharply in 2022. So it all came together, macro to micro. It's really been beautiful. But now we have this digestion period. After outsized moves, you typically have digestion. Some call it consolidation, what have you. Some call it indecision. They just really don't know what the market's going to do. And right now there is this debate, right? Recession to be or not to be. So I'm looking at this underperformance, relatively speaking, for the year in both stocks and bonds. I don't see a risk reward. I have a better word for it. Unattractive risk reward for both stocks and bonds. Now that does not, so that's a long answer to your question of what's 2023 look like. So I have, instead of high conviction like I did 2022, I have if then. So the if then for me is very much focused on if we can get the dollar back above the Dixie, back above 106 to keep, and I mean to get back above and stay above, then obviously that's going to be risk off. If we get also the 10-year to get and stay above 3.7, it is absolutely very inflationary impulse like, and it will cause de-risking in equities and obviously bonds. But that's a tight level right now, like between what happened in mid-October, which was central bank coordinated intervention, and I mean in huge efforts to cause the dollar to come back down. It was a wrecking ball until then, and yields with it, largely due to Bank of Japan, and I'll talk about that in a minute. That effort was outsized. So now this outsized move has to digest, and we have to kind of get some more data as it relates to what will yields and dollar do next. But that's the biggest risk to equities right now and bonds. The dollar, US yields, they make the weather, and their rate of change determines the severity. So I'm very focused on the levels of dollar and yields, as it is my line in the sand for that inflation deflation impulse. So kind of, if you can picture on a chart, obviously if yields move higher with dollar, we have an inflation impulse, unlike what we had back in October with heavy central bank intervention, which caused the dollar and yields to fall. Obviously, inflation expectations fell, CPI fell, and that gave a boon to stocks. So in order to kind of determine the next move for the market, it's very much a macro read. So let me go to that mid-October timeframe because it is critical to understand macro to micro. First and foremost, Yellen came in on October 12th and realized, right, liquidity in the treasury market was faltering. So she basically said, we're going to have to help them out. 13th, if you notice on the charts, is actually the low of the market, a massive intraday reversal, historic. Fast forward 1 week, only 1 week, because I know I run a live trading for clients. That's recorded. They can, and it's there. YouTube, little segments go up there, but we actually captured that live Bank of Japan decision on Friday, our time, morning, middle of the night, their time. Bank of Japan did a massive yen intervention. It had not been their first one. Their first one in 24 years was in September 22nd. So they came in, they defended, and realized it wasn't enough to really move the needle. The dollar just kind of paused. It didn't fall. October 21st, they came in again with a massive yen intervention. We caught it live because it happened to hit my dollar yen carry trade price target of 151, which is USD JPY. And they literally came in the morning at this and did their yen intervention, which was ginormous, to basically support their bond market, which caused the dollar yen to come down and the dollar, US dollar, and yields to come down. And then they came in and put even more into this intervention move on the 24th of October. But what else happened on October 21st? Fed did their little Wall Street Journal Fed Whisperer article of a potential pause. The market got all excited, right? Animal spirits started coming in, woohoo. And then November 10th, we also had the CPI, which was a very large miss, for lack of a better word. It dropped very strongly, which was unexpected for the most part. So that also gave more animal spirits. But the central bank intervention was all around that mid-October. At the same time that the Fed was doing this, whisper article about a pause, at the same time Bank of Japan was doing massive yen intervention. We also had a very large $18 billion US dollar swap with the Swiss National Bank, literally within days of the same occurrence. We also had PBOC, okay, that China came in exactly the same time. I think it was the Monday or Tuesday after the Bank of Japan intervention, because I read the headline out loud in my live trading room, and it literally said, China orders state banks to stem the selling of stocks. In other words, you have to buy stocks now. They ordered their state banks. And if you look on a chart, you'll see, oh my goodness, right? We looked like China, the narrative was China is uninvestable. Literally the very same week that China came in and said, order their state banks to stem the selling of their equities market and buy up Chinese issues. And that was it. That was the bottom. That is a perfect example of macro to micro, where you have government intervention. And I don't mean just globally that all happened, but also just in that little, microcosm of China, they came in and started to really talk about more fiscal spending, growth initiatives, and backstopping real estate developers that were obviously, on their backs. So that was coordinated liquidity. Lack of a better word, it's liquidity. And I could see it in my models that we were having net buying come in from October bottom, mid, and then more, and then more, and then more, and then more. The point is, the only time we had a short duration net selling over net buying was over the December Christmas, Santa rally, which didn't occur. It actually picked up in earnest on January 4th, at least my indicator. And then the 5th, SPX and the indices finally broke higher out of a consolidation that had been in place for 2.5 weeks. And the rest is history, as they say. So we had follow through from January 6th right up until today. And the day of this taping is, well, not just today. It actually stopped on Thursday of last week. But the point is, we made it all the way through January, one solid month. We had the best NASDAQ performance since 1991. We had a massive short covering rally. I started tweeting about this, that it looked like a quant quake or forced buying, and it ended up being exactly that. So the short covering book was basically unwound. All of those protracted downtrends in your growth high beta plays that had been stabilizing but not moving higher. And every time you tried to go in, if you were an active trader, you just, get chopped up. And so lots of folks were getting discouraged. Then, of course, the speculation starts coming in again in January on that short covering rally with Bitcoin and all the mid cap, tech plays, and of course the mega cap tech plays. So you had this rotation higher. Breadth exploded positively. Net buying continued strongly higher just until last Thursday, actually. And now we're petering out. So are we ready for the next leg down? I need to see the net selling, and then I'll be able to time it with precision. But right now we are petering out. We are digesting a very large momentum move that has happened in January that has basically pulled in a large number of bulls on every time frame. Chase, swing, trend, which are how I define short, intermediate, and long, thinking that this is the next, this is the reason we're going to continue higher and break out and have a continuation of the secular bull market. Color me skeptical.
Nice. So you touched on a lot of points, and so you made it very clear that the key important things for the markets are going to be the dollar and yields. And I guess they're going to be driven by the Fed, of course, and by inflation. And you touched on the labor market, and we got a very hot number in the labor market with the lowest unemployment rate since 1969. And we are seeing wage growth continuing. Do you see it as a problem for inflation moving forward? And if we also adopt what you said about this liquidity injection that came from other central banks, when you see all of this, do you think it can have an impact on inflation moving forward?
So this is a great question, but it depends on your time frame. So for example, this coordinated central bank intervention of size is the reason for the season that the dollar and US yields pulled back. End of point, right? So the problem is that that's a diminishing rate of return. In other words, it takes an enormous amount of dollars converted into yen for the Bank of Japan to do what it does, to have its effect. Now, it's going to be made even harder as they have more inflation percolating up. I watched that kind of the inflation prints come out, and they are very strong. In other words, their wage inflation is now a bigger problem than our wage inflation. So Asia in general has still lots of inflation increases, while we have short-term pulled back down, right, in our kind of month over month. We're having the next one, by the way, on Valentine's Day, our CPI, and it might run a little hot. But the point is, the time frame of this inflation deflation talk is very much about the trend. The trend, as I mentioned, deflation of wages ended with COVID. Bonds stopped going up in August 2020. Those trends are broken. So I'm not, if I'm talking big picture, I'm not going to be so interested in Tuesday's release of CPI, right? Or necessarily, I am going to be watching, however, Japan's March 20th inflation read, because I think that's going to be very impactful for their yield curve control. And we already know that that correlation to US dollar in yields is extremely tight. So does that make sense that over here, I'm not spending like hyper focus on it? I think that inflation's structural. I think that wage inflation will come down as the tightness of monetary policy, kind of helps, and productivity, has a little bit leg up here, and then it will reverse again. In the same way that we're seeing the housing market obviously stopped going up, right, and pulled back down. We had a mortgage rate lock of sorts, meaning that rates were so, the 30-year was so high at 7% that it made it beyond unaffordable. Everyone was worried that, anyone who could sell didn't want to. And that kind of creates this kind of frozen market. But I'm not looking at this particular month to month inflation deflation as it impacts the market. I'm looking at dollar and yields as it impacts inflation expectations and the Fed's decision or reaction function. So for me, it's still going to be focused on dollar and yields. And right now, Bank of Japan has my attention because they're the ones that are grappling with rising wage inflation. And that is actually more meaningful because of their whole, structure of, they own 50% of their bond market, their debt to GDP of 132%, et cetera, et cetera. So I think that that's more of a weak link in the system, that I would rather focus on that risk, because we know that the Fed and Treasury can come in and they can do a lot of tweaking, right? Not only to their current step down that they've done 3 from 75 to 50 to 25, but also in their rhetoric, also in their QE, QT, back and forth, they're buying, they're selling month to month. It's very much liquidity is driving the animal spirits, there's no question, but I'm looking for the weak link internationally. And right now, the two that I see, Bank of Japan risk coming up March 20th, and then Bank of China, the PBOC. For me, this has been a fabulous macro to micro swing trade from the bottom, right? From when they said, ordered state banks to intervene the selling of their stocks, of their market, and buy stocks, to right now where there's an impulse where they're topping out. It's getting weak. So now it looks like they're going to have a little bit of a growth pullback, and that will impact liquidity. So to me, I still see this as the Fed could make it a lot easier if they just clarified their forward path. Right now, there's so much talk about, the recession. It doesn't exist. It's a soft landing. I don't even worry about that. Honestly, we'll know when we get there. But if they could just simplify things and say, we're going to continue to incrementally raise federal funds rate, right? Regardless of inflation. And we're going to do it for a long time, because we need higher nominal interest rates. We need them to stay above inflation so that we can deal with this massive debt. And more importantly, the interest that must be paid on this massive debt. But they're not going to do that. So we're trying to basically read between the lines. And the best way that I can do that, honestly, is to stay very focused on dollar and yields.
Thank you for this. And so do you think that in the meantime, for investors, the best thing is just to sit it out and let's say buy bonds, which now are actually yielding something? So I guess Tina is dead because there is an alternative. Or do you see any opportunity right now, or just like waiting for any clear signal in either direction?
I love this question, because I would never, ever had thought that I would be in the camp, given I'm so active, right? I mean, literally active traders, active investors, active money managers, to be saying this. But yes, we are paid to wait. And I did an article, I was interviewed on Market Watch, I think just like, I don't know, Fed Day. So very, very recently. And it's pretty clear, T-bills are paying pretty well, and you get those flyers in the mail and come park your cash for 4.5%, 5%. And then yesterday we had the 10-year auction, and the debt is yielding 3.6%, and it was fully subscribed, right? So that really just translates to a lot, whether it be fixed income or retail, indecisive about our recession risks, indecisive about the Fed's ability to give us a soft or hard landing, indecisive about whether they really want to go into strong equities, given earnings downgrades and declining EPS, which I absolutely have as a baseline model. We have a lot further to go in earnings being ratcheted lower. And they're seeing a low unemployment rate, but they're also seeing layoffs, right? There's also some skepticism in the survey, the household survey that came out on the unemployment print. I tweeted a great kind of study on the discrepancies there. Not that it's conspiracy theory. I'm just saying there's an adjustment. There's some major adjustments that have been done to the data, and it's not my wheelhouse. So I look for folks where it is their specialty, and it was more than strong, but will likely be revised lower in Q3. So it's not really helping us, right? It's not really a trading signal. It's not really actionable, is my point. So I think we are, a lot of folks are getting paid to wait. And that was the gist of my article. And I'm, of course, going to be looking for the best stocks. I have a trend, product that is just focused on sector rotation and the best relative strength leaders in those sectors for multi-month advances. It's a long only trend portfolio. It's been doing great regardless, and it does not have tech in it, by the way. So the point is we can still, of course, find short-term momentum rotations or value rotations. We can find solid, durable trends in durable companies that have, operating cash flow, and they're not PE to the sky. We basically have, or valuations that are, still outrageous. We still have a lot of opportunities to pick our spots. But for most investors, after what they experienced last year, and given the benefit, if you will, of higher interest rates on fixed income and cash, investors are now with an option. They are being paid to wait.
Yes, and I feel like, because at the same time, like if people now look at the markets, we have just been through one of the best January in decades, and being long right now seems like trying to pick up pennies in front of a steamroller. But at the same time, markets can stay irrational more than people can stay solvent. So shorting can be risky. And also we don't know what's going to happen with inflation and the Fed. So yes, I agree. Investors are getting paid to wait right now. It might be a great opportunity to do so. Now, I want to ask you about something.
And also, just real quick on that comment, I do believe, this is my, my contention, it has been since that summer of 2020, when deflation of wages ended with COVID and basically things over paper and blah, blah, blah. The point is, we do have structural inflation, right? So my baseline bet is that since a few years, I've been saying we're going to have waves of inflation and waves of equity bottom. So to me, this is a dance. We danced up the mountain. Now we're dancing down. So I think investors also kind of need to realize that unless they're active or they're really well-skilled in a particular sector, or, that kind of focus on given stocks, just to buy the S&P now as passive investment has more risk. Right? They saw that last year. NASDAQ fell 35% and SPY fell, and they don't want to experience a 2001, let alone a 2008 rotation again. And I believe that we're still in that rotation. So in that kind of parallel where we have one more leg lower, right? We just don't have enough proof that we've bottomed. So yes, I think that's one of the reasons why it's an incentive for some to go more into cash so they don't get chopped up. And the second thing is, typically after we've had this kind of controlled demolition in the markets last year, in other words, the Fed was very good in making sure that we did not fall off a cliff. And every time we got very close to doing so, I would tell clients, brace, and it only happened a few times, I think 3 times in the whole year. I said, brace for impact if bulls don't defend here. And one of those times was July 15th. The second time was October 20th, right before the Bank of Japan came in and did their massive yen intervention. So I can see this. I can see the selling in the market, the distribution before we roll over. Okay. I'm not seeing it right now. So this rotation hasn't really peaked, in my opinion, this current rotation. But when it does, it can roll over with vigor. Very, very, that it's getting more and more fragile. So the moves are quicker. And that means that this year we actually have more potential for volatility spikes. We didn't have so many last year. We had, again, we kind of danced down the mountain and it was controlled. This year is where we get into what I call that kind of dangerous area where we could actually have some volatility spikes of size. And in lieu of sector rotation, we will have volatility, and that reprices everything. So I'm for the first time, also very cognizant that you are paid to wait. But if you're active, that's very different. There's still lots of opportunities in the market to chase and swing.
Yes, and yeah, because with increased volatility, there are more opportunities to take a side, and if the side is the right one, there are a lot of profits to be made. Now, I want to ask you about risk management, because I guess for a lot of traders and investors, it's something that a lot of people struggle with. Do you have any specific guidelines that you follow to manage risk?
As I mentioned at the very top, right? Dollar and yields are the technical reads that I can make Macro, as it relates to event risk, I think is very, very meaningful. My intermarket helps with sector rotation, that's my intense study and secret sauce. But you mean like the saying, which I have been known for, don't risk anything more than you're willing to lose, right? So from a risk management standpoint, that's why folks are putting a good chunk in cash until things kind of settle, until they feel confident that a bottom is in, or that the liquidity has come in sufficiently enough to bring us to all-time highs and above. But it becomes more fragile at that point. But because the Fed is in a hiking regime, I mean, it's changed, right? So that is a big, big deal. It's no longer free money. You got to earn it. You got to make sure, that you can pay it back. Eyes on the prize. It's a very different market now. So I think speculative assets will have a much harder time of inflating. And we still have a Fed that's trapped, which means that they have no good options. They can't hike too aggressively. We saw what happened. It started to create a dollar strength that was panicking rest of world, and which caused a lot of this, drama, right? The SNB dollar swap, the Bank of Japan intervention, et cetera, et cetera. They are very much not able to also ease too significantly, or I would say even pivot, let alone pivot, because then inflation rears its ugly head again. And it also unleashes animal spirits to bid up those speculative assets, which create more inflation. So this whole cycle for them is basically an exercise in frustration, I would imagine, for them, because they really don't have a good plan. They don't really have a good plan of how they're going to get debt down, how they're going to get inflation down, except through tightening. But if they tighten too much, then it hurts everyone, Wall Street and Main Street. So they have now talked about how they could cut, this is later in the year, and increase QT. So, they're trying to be creative, but in a nutshell, Fed is trapped. And that's another reason why I think some who are not active in the markets are going to go to cash, or fixed income is going to gobble up those, 3.6% 10-year debt yield plays and be happy, because it's safer than the alternative, which is not knowing how the Fed's actually going to land this plane.
Nice. So before we finish, I'd like to tap into your experience. What do you think are one or two fundamental traits of a good trader and investor?
Top of the list for me. Top of the list for me would be trusting in your ability to interpret the market in your own language. So I think that young and old, traders who don't have confidence in their market read will follow maybe a consensus narrative, or, maybe a particular mentor or whatever research service that gives them what they think is the panacea, right? The perfect pitch. But in reality, my best clients are the ones who have the same world view as I do. My best clients. So I don't mean for the Discord newer clients. That's its own community. And that's because I saw, folks like you who are just very savvy and very addicted to markets, and also want to trade for the long term. They understand that this is a source of wealth creation. So that's a product that I created very much for kind of young momentum traders to learn how to trade correctly. Let's put it that way, and interpret the market in their own language, so that they can grow, they can pull up into an intermediate trader, and then from an intermediate trader in time, if they stick it out, to an advanced trader. So my baseline, belief is every successful trader was once an amateur that never gave up. And the best skill that you can learn as an amateur trader is to learn to interpret the market in your own language. So you study it, and you see what fits, and you see what you understand, and you practice what you understand and not trade someone else's ideas or someone else's style. You find your own. That's extremely critical, in my opinion. And the second is do not risk more than you're willing to lose. So if you start just taking gambling bets because you got the frenzy, you got that kind of gamification feel where zero DTE options, which is days till expiry. I call it destination till empty, where you place an option and whoo-hoo, it makes 100% or you lose 100%. Okay, maybe that's your thing. It's not mine. But the point is that type of risk is not very controllable. So if you go into the trade, risk is really not, risk happens when you don't know what you're doing. So don't risk any more than you're willing to lose. Hope that makes sense. Those two things are at least what I have found in my journey, and it's not done. I know maybe you were looking for something more tactile, but I'm not really thinking that's going to help so much. I think if it's a newer trader, then it's very much a focus on finding your place in the market, how you interpret it, and just really, really build on that. You'll do fine.
Thank you. It actually was really helpful because I think many times people try to copy what they see out there, but I think there are many different styles, and different style can work, but you have to find your own style, perhaps, as you suggest.
Yes, and there are many ways to make money. The trick is not to lose it.
So Samantha, this conversation has been great. Thank you again for taking the time to be here today. Now, before we finish, where should people go to learn more about you and LaDuc Trading?
LaDuc Trading, it is at laductrading.com, LADUC trading.com. And I am very happy to also, share some of my insights on Twitter, where I am at Samantha LaDuc. Also have a company Twitter at LaDuc Trading. Again, I have a beginners, intermediate, and advanced products, Discord, Treasure Hunters Discord, Fishing Club, which is where I personally run, live trading room. And I also have the Macro Advisor Edge, very much focused on those who actively manage money. It's a lot of macro to micro. It's a lot of live trading room, 10 contributors, including myself, custom trade support, all assets, all time frames. And I love working with clients. And more importantly, I like very much, helping them make money and avoiding the loss by timing the turns.
Great. Thank you. Thank you so much.
My pleasure.